What does this stance that you just articulated mean for your position vis-a-vis stocks?
Nothing really. I mean, I think the recovery trade is still on because the market is discounting those future rates of growth and a return to normality. And, it's funny, I took a flight yesterday for the first time since March 6th of 2020. And Newark was kind of busy. Charlotte, North Carolina was kind of busy. People are getting back to it. I mean, traffic is still somewhere 40-50% below last year's, peak levels, but it's above the 97% discount, if you will, in air traffic that we saw a year ago this month as well. Right. So I think you stay the course with respect to that recovery trade because it seems to be on.
Michael, you say we've had a good year this past quarter. It's a great line. Does it mean the party has to stop because we've jammed basically a year's worth of gains into 3 months?
It doesn't mean that the party has to stop, but I think it does mean you have to catch your breath and make sure you know what you own. There's reason to be cautious. Mike Santoli has a great piece on CNBC.com in which he says, basically, look, we're in a bull market, period. That's really important to kind of look around and see where we are. So the trend is up. You're listening that the economy, according to Steve Leisman and Fed President Waller, is going up. Right? And we're getting ready to let it rip. So could we have a correction? Sure. But there are so many tailwinds. I think the future continues to look very good for stock. You have to be careful where you invest, though, Tyler. There's still opportunities, still places where you can make money.
Yeah. Mike Santoli, he's a smart guy. Michael Farr, I'm curious. I mean, I realize the 10-year Treasury yield is up slightly today, but in general, we've seen that slip, and pretty notably in the last couple of days, despite the fact that we've had blowout economic data that's been reported. What does that signal for the market right now?
We've seen a couple of different reasons for that. There have been some technical reasons. There has been an increase in foreign buying. And, of course, the Fed has continued its purchases. But overall, it has stopped. The bond prices have stopped falling and the yields have stopped rising for now. It looks like we're still trying to put in that bottom and yield somewhere in the 175 range. That may hold, 180 somewhere, and may hold. Longer term, low interest rates are very good for continued future growth and for future valuations because you use a lower rate with which to discount those forward earnings. So I think there's still companies that continue to look good. The Treasury rate is key. But, you look at a company like a CVS. It's come back a little bit. It's got a great dividend, 13 times earnings. The integration is happening. A lot of people going in those stores to get their vaccine. Had my second one yesterday. I'm really psyched.
Shepard Smith here. Thanks for watching CNBC on YouTube.